As of right now, Wednesday, April 29th, 2026, the Navitas Semiconductor live stock price is sitting at $15.43 per share during this morning's intraday session. We are seeing a fairly volatile move here as the stock tries to stabilize following a heavy 80% surge over the last month. Looking at the screen, the intraday movement shows the stock bouncing between a low of $14.81 and a high of $17.23, which tells you everything you need to know about the current tension in the semiconductor space. The trading volume has been exceptionally high, with over 100,000 shares changing hands in the opening hours alone, as investors position themselves ahead of the first quarter earnings report coming next week on May 5th. What most people are missing right now is that Navitas isn't just another chip company riding the coattails of larger players. They are currently executing a massive structural shift that the market is only just beginning to price in. While the retail crowd is chasing the price action, the real story is the transition toward what the company calls Navitas 2.0. This isn't just a branding exercise. For the first time in the history of the company, high-power markets like data centers and industrial infrastructure now make up the majority of their revenue, officially overtaking the legacy mobile charger business that once defined them. This is the reality that is starting to collide with the expectation that Navitas was simply a phone accessory play. The general market expectation for a long time was that Navitas would struggle to move beyond the consumer electronics space, especially with the slowing demand in the smartphone market. People looked at the negative earnings and the cash burn and assumed this was a wait-and-see story for the end of the decade. But the reality we are seeing in the data is a company that has successfully embedded itself into the 800-volt power architecture required for AI data centers. When you look at the sheer heat and power density of modern AI server racks, the old silicon chips just don't cut it anymore. Navitas is using gallium nitride and silicon carbide to solve that specific bottleneck. That is why the stock has decoupled from the broader small-cap slump and started this parabolic run. However, we have to look at the institutional activity to see where the smart money is actually sitting. While the retail sentiment on platforms like StockTwits is through the roof, we've seen some massive names like BlackRock and Invesco adding millions of shares to their portfolios recently. At the same time, we have to be honest about the insider activity. Over the last 6 months, we've seen top executives selling off portions of their holdings. CEO Chris Alexandre and the CFO have divested millions of dollars in shares. Now, often this is just pre-planned selling for taxes or diversification, but when it happens during a massive price spike, it creates a friction point. You have institutions buying the future, while insiders are locking in the present. If you're using a platform like Robinhood or SoFi Invest to track your positions, you've likely noticed the hold rating that's been plastered all over this stock by Wall Street analysts. The consensus price target is sitting way down at $8.15, which is almost 50% below where we are trading right now. This is a classic case of the analysts being left in the dust by a momentum shift. They're looking at the trailing 12-month losses, while the market is looking at the forward guidance for 2026. This creates a high-stakes environment for the upcoming earnings call. If Navitas can prove that their gross margins are expanding as they move into these higher-value industrial sectors, the overvalued narrative will likely evaporate. But if they miss on revenue or show that the China exposure is dragging them down, that gap between the current price and the analyst targets is going to close very painfully. Let's talk about the business model for a second, because it's important to understand what you actually own when you buy NVTS. They are a fabless semiconductor company, meaning they design the tech but don't own the factories. They recently formed a massive partnership with Global Foundries to secure their supply chain right here in the US, which is a huge de-risking move. They specialize in wide bandgap semiconductors. In plain English, they make chips that can handle much higher voltages and temperatures than standard silicon while being much smaller. If you've ever used a tiny fast charger for your laptop that doesn't get blazing hot, you've seen their tech in action. But now they are taking that same efficiency and scaling it up to power EV onboard chargers and the massive power supplies that run NVIDIA's latest Blackwell chips. When you look at the competitive landscape through an online investment lens, you see them going head-to-head with giants like Infineon or Wolfspeed. The difference is that Navitas is smaller and more nimble, focusing purely on these next-generation materials. They aren't trying to maintain old silicon factories. They are 100% focused on the future of power. This is why the trading volume has been so erratic. We are seeing a lot of short covering mixed with aggressive institutional accumulation. It's a tug of war. On one side, you have the valuation hawks who say a company losing $30 million a quarter shouldn't be worth $4 billion.
On the other side, you have the growth bulls, who see a $3.5 billion addressable market in AI alone by 2030. The tension between expectation and reality here is focused entirely on the speed of adoption. The market expects that every AI data center will eventually switch to these high-efficiency modules. The reality is that building these centers takes years, and the qualification process for new chips is grueling. Navitas just added Gregory Fisher, an old hand from Broadcom, to their board. That was a signal to the street that they are serious about the grown-up phase of the business, moving from a startup vibe to a tier 1 supplier for the biggest tech firms on the planet. This leadership change is exactly the kind of move that precedes a major contract win, which is likely what the whisper numbers are betting on right now. I want to hear from you guys on this one. Comment below how many shares of Navitas you currently hold, or if you're looking to start a position at these levels. Do you think the AI power story is enough to justify this valuation, or are we looking at a massive pullback once the earnings hype dies down? Looking ahead, the catalysts are very clear. First, we have the May 5th earnings. We need to see if they can beat the $8.1 million revenue estimate. Second, we need to watch the 200-day moving average, which is currently sitting way down near $9.81. The fact that the stock is trading so far above its long-term averages suggests we are in overbought territory, but in a momentum market, that can last longer than anyone expects. The risk is that the mobile sector, which still accounts for about 25% of their business, continues to drag on the bottom line. If the transition to high-power industrial sales doesn't happen fast enough to offset the mobile decline, the stock will have a hard time maintaining its current altitude. The reality of Navitas Semiconductor in 2026 is that it has become a pure-play bet on the electrical grid of the future. Whether it's solar inverters, EV chargers, or AI server racks, the common denominator is the need for more efficient power. The expectation was that they were a niche player. The reality is that they are positioned at the exact center of the biggest infrastructure build-out of our time. As we see more individuals moving towards self-investing and using platforms like Fidelity or Interactive Brokers to find these high-growth opportunities, Navitas is going to remain a high-conviction, high-volatility name. In summary, we have a stock that has defied the traditional valuation metrics because the market is pricing in a massive shift in the fundamental business model. We started the day at $15.43, and the volatility is a clear indicator that the expectation of a simple growth story is being challenged by the reality of high execution risk and insider selling. However, the institutional accumulation and the strategic pivot to AI infrastructure provide a strong tailwind that is hard to ignore. Whether you are looking at this through a long-term retirement account or a short-term trading platform, you have to respect the price action. The gap between what analysts think the stock is worth and what the market is willing to pay is the space where the most profit and the most risk is found. Keep a close eye on that May 5th date, as it will likely be the moment where the expectation finally meets the cold, hard reality of the balance sheet. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.